In our previous videos, we've explored the fundamentals of investing, from understanding different asset classes to the importance of risk management. We've journeyed through the world of investments, unfolding the layers of asset classes and emphasizing how critical risk management is in this landscape. Now we're about to venture into a new territory. We're introducing a new ally in your investment journey. Today we delve into the concept of diversification, a crucial tool in every investor's toolbox. So, what exactly is diversification? In simple terms, it's the strategy of spreading investments across various assets to reduce risk. Consider this: you wouldn't put all your eggs in one basket, would you? Similarly, diversification is the financial equivalent of this old adage. It's all about not putting all your financial eggs in one basket. Imagine if you had invested all your money in one company's stock and that company suddenly plummeted. You'd be left with almost nothing. But with diversification, your investment is spread across a variety of assets. So if one fails, the others can help cushion the fall. Diversification aims to maximize returns by investing in different areas that would each react differently to the same event. It's about balancing the risk and potential reward by allocating investments among various financial instruments, industries, and other categories. For instance, let's say you've invested in both technology stocks and real estate. If the tech industry takes a hit, your real estate investments could still perform well, offsetting the losses. Diversification is not just about reducing risk, but also about potential for higher returns. Different investments will perform differently at different times and in different market conditions. By having a diversified portfolio, you're better positioned to take advantage of these varying market conditions. In essence, diversification is about spreading the risk and not being overly exposed to any single investment. It's about creating a safety net for your finances, where even if one investment performs poorly, others are there to soften the blow. Now, before we move on, please leave your comments below on this series and hit the like button. Please don't forget to subscribe and hit the notification button to get the latest videos first. There are several ways to achieve diversification in your investment portfolio. And two of the most common approaches are asset class diversification and geographic diversification. Let's begin with asset class diversification. This strategy involves spreading your investments across different types of assets, such as stocks, bonds, real estate, and commodities, to name a few. The main idea is that different asset classes often perform differently under varying market conditions. So, when one asset class is doing poorly, another might be soaring. This balance can help smoothen out the bumps in your investment journey, potentially reducing risk and enhancing returns. Now, let's move on to geographic diversification. This approach entails investing in different markets around the globe. Imagine having investments not just in your home country, but also in emerging markets and established economies across various continents. This strategy takes advantage of the fact that economic cycles and market conditions differ from one country to another. So, while one market might be experiencing a downturn, another could be on an upward trend. This way, geographic diversification can help insulate your portfolio against country-specific risks, offering a broader opportunity for returns. In a nutshell, both asset class and geographic diversification play a crucial role in creating a well-balanced and resilient investment portfolio. They function as protective shields, helping to mitigate the impact of market volatility and enhance the potential for growth. Whether it's through different asset classes or regions, diversification helps to mitigate risk and potentially enhance returns. Now that we understand what diversification is and its types, how do we go about implementing it? Well, the first step is to assess your risk tolerance. This means understanding how much risk you're comfortable taking on. It's a bit like choosing a spicy dish at a restaurant. Some of us love the thrill of a fiery vindaloo, while others prefer the mild comfort of a korma. Similarly, if you're comfortable with volatility and potentially larger losses, you might be more inclined to invest heavily in stocks. But if the thought of losing money makes you break out in a cold sweat, you might want to stick to safer investments like bonds or cash. Next, set clear investment objectives. What are you saving for? A new car, a dream holiday, retirement? Your goals will help determine the appropriate mix of investments for your portfolio. For example, if you're saving for a short-term goal, like a holiday, you'll want to minimize risk and preserve capital. But if you're saving for a long-term goal like retirement, you can afford to take on more risk for the potential of higher returns. Consider your financial goals and risk tolerance when diversifying your portfolio. You might need to tweak your investment mix over time as your goals and circumstances change. And don't forget, it's not just about spreading your investments across different asset classes, but also different sectors and geographies. Remember, diversification is not a one-size-fits-all strategy. It should be tailored to your individual financial goals and risk tolerance. Ready to take control of your finances and build a brighter future? Subscribe now for more expert tips and strategies to help you achieve financial success. Don't forget to leave your thoughts in the comments below. Give this video a thumbs up if you found it helpful, and share it with friends and family who could benefit too.